What is a vertical credit spread? A spread is any option trade that uses two options, typically one bought and one sold, to balance risk and reward. Credit is a kind of trade that puts money into your account from day one. Vertical simply means that the options have different strike prices and expire at the same time. The goal in all credit spreads is for the options to expire worthless, allowing the trader to keep the credit as a profit. InvestorsObserver uses two main kinds of vertical credit spreads. The first and most prevalent is a bull-put credit spread. This is a bullish position created by selling one put and then buying another put with a lower strike price for a net credit. The second is a bear call credit spread. This is a bull-put spread turned upside down. We're going to sell one call and then buy another call with a higher strike price, again, for a net credit. So we'll take the bull-put credit spread as an example and unpack how this works. So the first step is sell a put, typically out of the money. The goal with this put is that it will expire worthless. And since it's a sale, we get to keep the money that we got for selling it. This put does potentially obligate us to buy the stock at the strike price. We'll talk more about that in a second. The second step is to use some of the proceeds from selling the first put to buy a second, cheaper put. This put will be further out of the money. Hopefully this put also expires worthless, but it serves as insurance. It does that by giving us the right to sell the stock at the strike price. So how does it work? The sold put is a bet that the stock won't fall below that level. The bought put is catastrophe insurance, capping any loss. Between the two strike prices, we're looking at a smaller than expected profit or a loss. All right, let's look at an example. In this case, we're looking at a September 2025 bull put spread on Toll Brothers for a 35-cent credit. This means that we're going to sell the September $25 put for about 55 cents, and we're going to buy the September $20 put for about 20 cents. That leaves us with a credit of the 55 cents we got from selling the first put minus the 20 cents we paid to buy the second one of 35 cents. That is our credit. The potential return on this trade is that 35 cents, since that's our target profit, over the amount at risk, which is the difference in strike prices, 25 minus 20, and we got paid 35 cents up front, so the first 35 cents of a loss comes out of our profit. So our amount at risk is the difference between the strike prices less our target profit, which puts the return for this trade at 7.5%. We also have some downside protection. Downside protection is how far the stock can fall and we still make our full target profit. In this case, the stock was at 28.15. It can fall to 25. 28.15 to 25 is 11.2% of 28.15. But that's the downside protection on the full profit. We actually have a little bit more than that in terms of a loss because we don't start to lose money until the stock gets to 24.65. All right, so let's put this example on our chart. As long as the stock is above the strike price of our sold put, that's at $25, the options expire worthless, which is a good thing. It means we keep our credit and any potential obligations disappear. But what can go wrong? The stock is below the strike price of the sold put. We will have to buy the stock for that price, in this case, $25. Between $25 and $20, we still have to buy the stock for $25, and so we're looking at a smaller than expected profit between $25 and $24.65, and then from $24.65 down to $20, we're looking at a variable loss. At $20, the put that we bought kicks in, That's our insurance put, remember, and it allows us to sell the stock for 20. So the worst case scenario is we buy the stock for 25 and sell it for 20, losing the difference in the strike prices less our initial credit. No matter what happens to the stock below $20, we only lose the difference in the strike prices less the initial credit, or in this case, $4.65. Vertical credit spreads let investors bet that a stock won't fall or rise. The risk is constrained to the difference in strike prices less the initial credit. The strategy allows for relatively high returns while also providing some downside protection.